Hey everybody, it's Blair Nightingale here, Market Monday. Welcome, welcome, welcome. This is a time where we get to come together. I want to show you some things about the market, yes, but I want to show you specifically about all this talk of recession and downturn. We get together here once a week so that I can come to you and help you understand what is happening in the markets. Of course, here at Tradeway, we have tens of thousands of students learning to trade the markets right now, but also we've got a lot of people in our community who are, yes, on the short-term side of things, but on the long-term side as well. Now, normally here on Market Monday, we spend all of our time really fixated on short-term trading, stocks and options trading, and how to fit that for the market season that we find ourselves in. And certainly we have covered some of that as we've gone through this year, really looking at how do I make money in a market that's moving down? I was just actually sitting with somebody last night who said, you can insure your long-term portfolio? You can insure it. There's insurance for my long-term money. And most people have no idea that there's insurance for their long-term money. And we remember talking about options earlier this year. Options is not just some funny thing that Wall Street came up with that we can buy and sell. Options is actually originally intended to be an insurance contract. Now, we can use those contracts in interesting ways, but really the primary function, or at least the initial function of those contracts, in this case, a put option contract, is really to hedge the portfolio. The put option makes money when the stock moves down. So there's ways that we can use that. So that said, tonight I want to talk more about that long term. Yeah, there are short-term opportunities out there for sure. We like to say fear moves faster than greed. This market can fall a whole lot faster than it's gone up. Now, it has gone up very aggressively, but the market's down about 25% already. So tonight I want to give you three different things. I'm going to say this right off the top. Three different things tonight. The first one is, if we don't have a plan for our long-term money investments in the market, if we don't have a plan, number one, it's time to get a plan. I'm going to talk about that. Number two, how far do we think this market is going to fall? Now, of course, nobody knows for sure, but I'm going to give you some thoughts on the chart on where I think this could be going. That's going to be number two. How far do we think this thing is going to fall? And then number three, I want to help you understand that the markets are in a very, they're in a slide. They're in a place where we can't time the perfect top and bottom, okay? But I want to help you understand one very simple thing. And I mean that. It's very simple, okay? You do not have to be a highly proficient technical analyst on a stock chart to know, generally speaking, for the rest of my life, for the rest of your life, I'm going to tell you this one thing. And when this one thing is happening, you know that the chances of a stock market crash are significantly higher. In fact, this thing has happened in every stock market crash. And it's what happens right before a significant market recovery. Okay, so let's get into those things tonight. First things first, I have had the pleasure of sitting with a good amount of folks over the last 2 weeks and look at a lot of people's retirement accounts, something we do here at Tradeway. Yes, we teach that long-term or short-term skills, but we also are helping folks understand how to do the long-term as well. Okay, long-term as well. And one of the things that we don't do here at Tradeway, you've heard me talk about this before if you've been on with us, we do not leave this in all the way to the bottom. Ken, I can see you there. Good evening to you, sir. If you guys are joining us tonight on Facebook or YouTube, you want to say hi, have any thoughts, comments, questions, concerns, you name it, you can pop it right there in that comment box. And that will send straight over to me, whether you're on YouTube or you're on Facebook. If you're watching and recording, you can always write in to us on YouTube as well. There are folks out there watching that, and they will send that on over to me. So I appreciate you guys being here, regardless of when and which platform you're on. Thanks so much. And Ken, good to have you on here. As always, here's the thing, guys. This market is so, this is opinion on some level, but it's not fully just my opinion. I'll tell you what I mean in a second. The market is so inflated. The money has been so cheap for so long. There's been so much printing of money. There's been so much spending of money. There's been so much stimulus. Think about somebody who's just chugging Red Bulls, okay? What happens? Well, you get a big boost. You can go longer. You can take powerful stimulants. This is just economic stimulant, right? That's what this is. In fact, that's what they've called it. Well, anytime you use stimulants, you can get a response. But eventually what happens to the body, right? It crashes. It crashes. And you know what's almost infuriating about this, guys? If we think about this, and this is my passion for number one. Remember I said number one, if you don't have a plan for your long-term money, it's time to get a plan. It's time to get a plan, okay? That money that got pumped into this economy, if the government spent it, you paid for it. It didn't just come out of nowhere. It was tax dollars. They spent it, you paid for it. Guess who benefited most out of all of that money? Well, companies. And I'm not anti-capitalist, by the way, at all. Not at all. But that money was spent and it created enormous gains on Wall Street. Okay, I'm going somewhere with this. Follow me. It also meant that we printed a lot of money and we spent a lot of money we didn't have. Yes, there are some complications from COVID. Obviously, we've had supply lines, right? And there's probably a lot of economic and political conversation that goes into all of this. But a lot of that money that was spent, guess who's paying for it now? You and me. How? Inflation. Inflation. Okay? So tax dollars funded the stimulus. Over-stimulus has empowered inflation, which you and I now have to pay for. And you know what happens to the stock market? The stock market goes up, 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 right? If we're in long-term mutual funds, which is what most people are in, I know this from personal experience. I see most people are in mutual funds. Some people are over in low management fees. In fact, no management fees in many cases, ETFs, right? Cut out the middleman. But if we're in those, we're paying management fees on that growth. Okay. They're taking a cut. The growth comes, we hit the high last year. And then what does Wall Street do? As soon as interest rates start to go up, Wall Street says, all right, we're out. Why do you think the market's down 25%? Is it because mom and pop are getting out of the market? No. The big money has been getting out and rotating in the market, meaning they're moving from one spot to another. They're being much more conservative. They're selling. Okay? Well, what's happening to Main Street? Right? That's Wall Street. What's happening to Main Street? They're being told by their financial advisors that you have to stay in the market all the way to the bottom. Because why? Because Blair, you can't time the market. So hold on a second. Let me just recap that. We spent enormous amounts of money for overstimulus. Okay. Much of that money is not even spent yet. It's just set aside. Okay. We spent enormous amounts of money, taxpayers. That didn't just come out of nowhere. Now, some money did come out of nowhere. It got printed. And that's why we have, in part, massive inflation, which now you and I have to pay for. The markets went up considerably because of all this cheap money and low interest rates. Now, Americans in their 401ks and retirement accounts stood, depending on their exposure, stood to make a good return, although they still paid a lot of fees on that money. We take all the risk right? If we buy mutual funds, we take all the risk and pay the fees to them, whether we make money or not. Now, that can change a little bit depending on the advisor and the arrangement, but that's typically true. And then Wall Street gets those massively inflated profits, gets into that bubble and says, you know what? It's too risky. Why? Because interest rates are going up. We're taking our money out. And I see mom and pop, if you will, Wall Street versus Main Street. I see Main Street being told, that's you and me, leave your money in all the way to the bottom. Some of you guys have done this already, right? If you've been in the markets now, 2000, 2008, even through COVID, you've seen that happen. You lost a lot of money. You say, well, Blair, it came back. What, 5 to 7 years later? Opportunity cost? Wall Street didn't do that. They didn't wait. They didn't leave it in all the way to the bottom. They don't do that. It's funny that they might tell you and me to do that, though. Right? So maybe no plan is not a good plan. So we need a plan, right? We're going to need a plan in order to do something different, okay? And what I'm going to give you tonight is I'm going to grab it here really quick. I've talked about this on here before. I'm going to post this in the comments, both there on Facebook and on YouTube. We've got a free webinar coming up in Amped, our long-term program. We have not been riding this market to the bottom, right? We haven't been just sitting in there taking a beating. That's not what we do. We don't take an overactive role, but we take a more active role using our skill sets to help folks just like you navigate these turbulent times in the market and not sit next to me like so many people that I've talked to personally over the last 2 weeks that are sweating because the account's down 25, 30%. I haven't met anybody who's all the way to 30 yet, but above 25. And I remember I said, how far? Number 2, how far is this thing going to go? Right? I'll just preview that right now by saying, I think we've got a lot further to go than this. I think we see some pretty nice bounces upwards, right? And I think in bear markets, we always have. We've seen huge moves up, but those tend to precede even bigger moves down. And overall, we see a lot more ground given up on the downside. And I think that's where we're going here. We've probably just started in this case. Now, there's some more comments to add to that, but the risk on the downside is great. And in Amped, we even look in certain scenarios, right? This is a case-by-case basis. But in certain scenarios, we're not only looking to protect the portfolio in this kind of volatility and turbulence, these kinds of conditions, that is, but we're also looking to profit on the downside, as I said, right? What we would call inverse positions, right? Taking inverse positions on the portfolio, right? A portion of it, again, case-by-case basis in certain circumstances. But that's a totally different ball game than having it left in all the way down. To which somebody might say to me, Blair, you can't time the market. It's unwise to get out of the market and then try to time getting back in. Well, I'm going to tell you in point number 3 tonight why I don't buy that. I don't buy that. And I'm going to make sure that you know so that you don't buy it either. All right. Number 2, I'm going to head over to the chart here. We're going to go to the S&P. I just want to give you a couple of insights here on how far is this thing going to go? Now, I mentioned earlier, of course, we don't have a crystal ball, all right? We don't have a crystal ball. We don't know for sure how far this thing is going to go. We basically topped out right here. I'm going to zoom in a little bit for you guys. About right here, about 4,800. A little bit higher, 4,800. We're down about 25%. Now, that's pretty significant. You think about it, 25% already. No doubt there's speculation to say, you know what, we're down 25. Yeah, we might give up a little bit more. But 25% is a pretty big amount on the market So, I don't expect we're going to see that much further of a drop. Here's the thing, guys. With the way things are, we haven't really seen corporate earnings take a beating yet, right? And remember, this really cheap money we've had for a long time has caused corporate earnings here to just fly high. And the market has continued to hold that optimism that the economy is just going to grow and grow and grow. Well, with the situation we're in right now, yeah, the market's been pulling back, but that's mostly been on fear, right? A lot of it has been on fear. A lot of it has been on highly speculated, or I should say, highly speculative, there's probably even a better way to say that, highly inflated profits on a lot of high flying, for example, tech stocks, right? That have really pulled this index down. And the point for you and me is that I don't think this is necessarily the brutal selling that comes from these companies reporting much lower profits. Now, we have started to see some volatility in that. We saw Amazon, for example, make a big miss, and that definitely sent the market down. That hasn't happened in a long time. But, as we see people starting to hear recession more and more and more, what do? Start saving money, right? Companies are already starting to downsize. I'm hearing that. Even in the tech industry, starting to downsize, starting to let people go. I'm not trying to incite fear here. I'm just trying to say some of those conditions haven't really, from what we can tell, worked their way through the economy to the degree that they certainly could, right? We don't try to have a crystal ball here at Tradeway and say, this is exactly what's going to happen. In fact, one of the things we say as traders is our one of our primary rules is to remember anything can happen. The thing you don't think is likely could definitely happen. And I can promise you, watching the markets, I've seen it, right? I've seen just about anything can happen. So this market, if it decided next week to roar back all the way to 4,800, is that impossible? No, it's not impossible. The government could get involved. They could try to pump a lot of money into it. But you know what's much more probable, even though that's possible, is that the market continues to go down. You know why? Because they're going to continue to raise interest rates. And that's the big thing, right? Interest rates are going up. Inflation is at a 40-year high. People are spending less money on a lot of things because they're having to spend more money on a lot of other things, right? The necessities. We're spending a whole lot more money per household every month now than we have in 40 years because of that inflation getting to the levels that they are getting to. I don't think we're even really there yet. In fact, I was telling somebody yesterday, and again, my goal is not fear here, but the market is definitely in a fear state. It's in fear, right? But I don't think it's in panic. I don't think it's really capitulated to a major catalyst that could give us a significant downside drop. Now, we may see something a little bit different than what we've seen in the past. But at any time in the past, as those interest rates have continued to grind away, which remember, the goal is to slow down the economy. That has started, but they're talking like they're going to continue to be more aggressive. And that's really why I don't think we've really seen this whole drop play out yet. Now, if we get back to, let's say, right about, I'm going to pull my chart up just a tiny bit here so I can see. Right about there, that would be after COVID, or excuse me, right before COVID, right? That's looking at about 3,400. We're at 3,674. 274 points to get us back to where we were before this administration, before COVID, where we were at one of our strongest economies ever. So just consider how far and how much higher we've gone. You've heard me mention this here on Market Monday multiple times. It's just perspective, right? You can see the chart I'm showing you right now. That is not a long time frame, okay? When you look at, say, even right here, where it really stayed above those pre-COVID levels right here about November 20. That's an extremely aggressive move upwards. So even to get back to that level right there, that's only another 260 or so points to the downside till we get back to that level. And below that, I mean, could we possibly even get down to say 2250? Now, that's a much more bold projection. Now, I'm not making a prediction today, but my job as a trader is not to predict what the market will do because I don't know for sure. But it is my job to consider what the market might do and plan accordingly. Now, I'm going to talk in my third point tonight about how do I know based on history, not just a trader's hunch, when the markets are going to get soft, right? They're going to drop. You're going to see volatility and the chances of recession get much, much higher. Well, the opposite too. How do I know when that's going to reverse and we're going to really start to see a new bull market and we're going to see that economic cycle turnover, right? That's something I want to talk about, but I have to prepare for what is possible. And is 2250 possible? Back down? I was watching a video earlier today from Michael Burry, who, if you remember The Big Short, he predicted the housing bust in 2008. Actually, he took out positions on the housing market in 2005. Okay. He sees this market going down way further, way farther. And he has reasons for that. I'm not going to go into all of that right now, but there is a wider spread acceptance that we're in a significant bubble here and we need to be careful, which is why number one tonight is we need to have a plan. If you don't have a plan, make sure you click on that link to see what we do here at Tradeway. It's a no pressure, no obligation webinar. You can come, you can join and see what we do, how we do it, and how we feel like the scripture informs us on how to do long-term investing, right? But 2250, that's I think about 54% of a drop. Now, 54% is pretty aggressive. But also keep in mind, guys, if we haven't worn out the word unprecedented by now, we have had unprecedented stimulus into this market. If this market is built on cheap, free almost money, and Wall Street continues to say, hey, things are worsening, it is possible we could see a decline to that level. We've been to that level. In fact, a lot of bear markets we've had have bottomed lower than the previous bear markets. Okay? So it's possible that we see that. And we want to make sure here at Tradeway that you guys are ready for that. And hey, for you short-term traders out there, period, those are some pretty tremendous possibilities and potential in what I just talked about. So we also want to be active and ready for that as well. Times of volatility definitely bring difficulty for certain skill sets, but times of volatility actually bring, I was going to say bonuses, benefits for other kinds of skill sets when you understand really how to work with options. And that's something we really want people to be able to understand. So here, this line right here, this is our 38.55. That's our bear market line. So I wouldn't be surprised if we battle and try to get above that again. But I think over the long term here, guys, the Fed, and I'm going to switch to number 3 now. The Fed has said, we got some comments here. They're going to continue to raise interest rates. Now, they just did a 3/4 basis point, 0.75. And they spooked the market a bit when they said, well, first of all, they did what the market thought they were going to do, which was raise it 3/4 point. But they said something that the market didn't think they were going to say, which is, we're going to have to do this again. We're going to have to raise it like this again. So expect volatility to continue. As long as the Fed is aggressive on interest rates, it's going to drive the market down. You're going to see bounces. You're going to see volatility, but it's going to continue to drive that market down. Okay. Now, I mentioned multiple times something simple, and it is simple. This isn't even going to take a long time. For the rest of your financial life investing, I told a 16-year-old this yesterday, right? And I wish somebody had told me when I was 16. Now, he actually takes an interest in it too. And I probably wouldn't have when I was 16, unfortunately, because I didn't have a mentor, a coach, a father, somebody in my life saying, this is really important. You need to learn this. You need to get this squared away in your life, especially when you can start young. Those of you out there who didn't start young know what I mean. But what I'm saying is for the rest of our financial life, no matter where we're at right now, when the Fed begins to raise interest rates, let's say any period of time, fiscal policy, monetary policy, and they have not been raising them, the market tends to do pretty well. Okay, I'm making a general statement, but when they're not raising rates, the market tends to do pretty well when they're low. When those rates are low, right? It's causing stimulation. It's trying to stimulate growth. That's the point. As they begin to raise them, for whatever reason they raise them, as they begin to raise them, you're going to see eventually the market. I spoke to a friend of mine who is a financial advisor, and we were discussing where the market's at. He said, I think we're good. I think we're fine. I think we're going to be okay. My final thought in that conversation was we have to know that the Fed is going to grind this market down. Okay, and they hadn't done much for raising rates at that point. They just talked about how they were going to have to be more aggressive. And since then, they have been, and of course, the market has lost almost 30%. Okay, it's not because I had a crystal ball. It's because I recognize interest rates have so much to do in its current form, the way that the Fed and the market have a relationship. This isn't just an economics class, guys. I'm telling you, your opportunity, your money, tied to what the Fed does. Wall Street pays attention. We ought to do the same, right? When they're going up, the market is eventually going to give in to some volatility and it's going to come down. Now, it depends on how aggressive they are. If we go into a full bear market crash recession, technically we are in a bear market in the S&P 500. What do I look for to start to see a turnaround? Well, I'll tell you what I'm going to look for. As soon as they start bringing rates down again, hey, we've cooled that inflation or we've started to pull it back. We're going to start cooling those rates. We're going to start letting some money flow into the market. I'm not talking about printing money. I'm talking about cheaper. Let's let that money flow through the system again. Let's lower the interest rates. It's cheaper for us to buy a home. It's cheaper for us to borrow money. Businesses and banks are loaning, and that's the point. That's when we tend to see things turn around. I'm not saying it happens the next day, but that tends to respond. The market is what we call a leading indicator in our economy, right? So it tends to be a pretty good indicator of where things are going overall, okay? And interest rates have such a huge deal. So if you didn't get anything out of this tonight, except that, oh man, interest rates. And that's what I told this 16-year-old. I said, wait for the Fed to go ahead and start lowering interest rates again. Watch the markets, right? And when you're in your 20s, maybe, we'll see how long the cycle is, and they begin to raise them again, hey, you have a flag right there. You can start to use your skill sets and assess what's going on. But the season is changing, right? When interest rates change direction, you can know the season is changing. That's something I want you guys to have. It's not that complicated. Yeah, sure, maybe some of the economics behind it can be complicated, but that in and of itself, hey, we can look that up on a Google search, right? You can find that right here every Monday. We talk about this a lot because this is the main thing that the markets are looking at. Ken says, trade what you see, not what you think, right? Trade what you see, not what you think. You definitely have to lean on your skill sets. Right? There's these stories of pilots, right? And how pilots must learn to trust their instruments. They must learn to trust their instruments because they can get in cloud cover and they can have a sense of direction that has become warped. I think I'm going this way. I think I'm doing this. And they may actually find that they think they're climbing in altitude and actually they are plummeting towards the earth, right? They have to trust the instruments, right? They have to trust the instruments. And as traders, that's what we have to do too, right? We have to trust it because our biases and our emotions alone don't lead us well. We need our instruments as well. Okay. Ruben says the so-called experts are predicting a recession in 2023. Others say we're already in one. So here's the thing, Ruben. It's a good point, right? We're in a bear market as of a week and a half ago. But when did the bear market start? Well, technically they say, well, it started at the beginning of the year because that's when the market started to recede. We stopped making new highs. So that perspective says, well, we're in a bear market / recession because it started back here, even though now we're over here. Okay. Some say, well, actually, technically speaking, it's when GDP declines for 2 quarters in a row. Okay, we get a report on GDP in July, right? So if that is down, then technically that will be 2 quarters in a row, and we are officially then in a recession according to that. Now, so as you mentioned, some of these experts that say, no, we're going to get that later, right? They may be defining that in certain ways where there's a more broad-based measurement as far as how we're doing in unemployment, company earnings, and things like that. Okay, I will say this to your comment. They were saying late 23, then they're saying early 23. Right now, I hear some late 22. So to be totally honest, I don't pay that much attention to them. A little. I mean, I want to know what big money is talking about. But as far as their predictions, the Fed chair, Powell, in 2020 and 2021 kept telling us inflation is transitory, right? The former Fed chair, Janet Yellen, said the same thing. In fact, I think last month she apologized for just being wrong. She just said I was wrong. Well, we're not trying to sit on a high horse here. But there's certainly plenty of people in our tradeway community, and I think across the country, who thought, well, that doesn't really add up, right? Transitory. It seems like what we're doing is making it worse, and we're just going to keep doing that. And it did make it worse. And then they turn around and say, sorry, we got that wrong. It's just, I don't listen to the experts in that sense, right? And here at Tradeway, we're not expecting you to do that, right? We can learn from people. I hope you're learning something tonight. But the point here isn't just to tell you what to do. The point here is to show you how to think and how to do it for yourself, okay? So that's what we really want to help folks do. And in fact, to close tonight, to finalize and finish our AMPed program with that link that I popped in the chat there, actually, we have 2 ways of doing that. Ben Russell, the director of AMPed, is going to show you on that webinar. We have a self-directed program where we're actually going to help you know how to build out that portfolio, how to rebalance and manage it to protect it. But it'll be something that we help you do. We also have ways where you can come in and we will do it for you, okay? We offer both. We're big believers in learning to fly your own financial plane, but there are some benefits to each of those options that Ben wants to go over with you. I'll let him do that, but certainly it'll be a good use of your time. Again, sitting with many people over the last few weeks who've lost significant amounts of money, and not one of them. Now, not every one of them had a financial advisor. Some of it was self-directed. But those who did, not a single person told me that their advisor reached out to them to give them a plan on what it was that person was going to do to protect and promote their money during this volatility. Okay. So let's do something better than that. We got to have a plan because it could go a whole lot further, and it's already gone far enough anyway. Okay. There's no indication that this thing is going to come roaring back into a bull market economy right now, right? That's just not on the table right now. Okay. There's always government intervention, but I think that would only set us up for the same scenario down the road. Okay. And then following those interest rates, right? Ken just let me know the link is throwing an error. Interesting. All right, let me try. Thank you for saying that, Ken. Let me get you guys something else here. I may have inadvertently chopped off part of the link potentially. Let me just go ahead and pop it in there again. Yeah, I'm getting the same error. I'm going to give you guys this one instead. I apologize for the trouble on that. Let me pop another one in there. There we go. That second one, or that last one I put in there, guys, that one is going to work. Okay, I just tested it there. So I'll let the girls over in marketing know, and we will make sure to fix that for you, because we're just trying to make sure that y'all get on there. But that last link I put in there works just fine. That'll get you a plan. Get in there, learn some things. Ben's going to show you some stuff, right? He's going to spend some time on there just showing you what have they done for folks who are already in the AMP program, right? Don't give up $50, $100, $150, $250, $350,000 trying to figure out what's going on in this market, hoping it's going to come back. Come spend 60 minutes with us and get a better plan, right? It's worth it. It's worth your time. Appreciate you, Ken. Thank you for saying that. Troy said, I remember Carter and then the high rates of the Reagan years, expensive auto and house loans to pay. We were living in more interesting times to learn. Yeah, I mean, those were extreme conditions, right? We haven't had inflation like this in 40 years. And so the aggression of these rates is pretty high, which is, it's kind of a little bit of a perfect storm here. Because when you get those incredibly inflated equity prices, right, where the market is just euphoric and going up, 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 up to potentially give us a bubble. Now, some would argue with me and say it's not as much of a bubble as I'm saying, but looks a lot like a bubble to me. And a lot of experts are saying that. And then you get inflation that is as bad as it is, to where they need to be very aggressive to slow everything down. That's what I say. That sounds to me more like a perfect storm, because you've got more ground in the market to give back, and you've got some factors in motion to expedite, to accelerate giving it back. So when I say we're down 25%, and there's good reason to think we've got a lot further to go, I think it's got legs for sure. All right. I appreciate you guys being on here. Make sure you click that link that's in there. It's the last one I sent. I apologize again. Thank you, Ken, for pointing that out. But that last one in there works, and you can join us. And that's just coming up actually in just a couple days. All right. June 23rd. June 23rd is the webinar. All right, guys. Appreciate you all for being on here. Let me know if you need anything at all. You have questions about this. Maybe you're watching by recording and you got a question for me. You can always email at support@tradeway.com, care of Market Monday, right? Blair Nightingale right there. You can put my name in the email. They'll send that over to me. I'll take care of it. All right, guys. Appreciate you. Let's get a plan and take advantage of what's happening so that it doesn't take advantage of you. Appreciate you guys. Good night.